I stressed right at the beginning, is looking at things at a very, very high level. This is like the 100,000-foot level looking down at a market in aggregate. You will have clients or you will have interests in different segments of the market, different parts of the market. What you want to do is this kind of analysis, but drill down. You need to use the SRX data to drill down into the areas that you're interested in, because you will probably get very different results. You might find there's lower risk, or you might find there's higher risk, or there might be much higher returns. You know, it all comes down to, and I should say here, the return numbers don't include rental yield, so you can probably bump them up a little bit for that. But you know, those are the sort of things you need to be thinking about. You need to drill down, and the nice thing about the SRX data is it gives you that ability, it gives you that granularity, it gives you that detail that actually allows you to make much more informed decisions, because you're able to get the data tailored to the kind of properties you're looking at, the area you're looking at, the size you're looking at, the number of bedrooms that the property might be having, landed, non-landed. There's so many different ways, of course, that you can look at this, but at a very high level, you know, this is the sort of approach you would take.
And that's, so when we look at capital gains, for example, through the data that we have, you know, some people are doing really well, 15%, 20%. Some people we're seeing negative, and the end result is the average return is somewhere between, you know, 3 to 5%, which is not bad given what cash is. But then the interesting point in this chart is that the standard deviation is pretty high, so that just suggests that there's more is that right? Is that there's more fluctuations? So you're going to have a bigger band of returns?
Absolutely, and that's what it comes down to, this idea that there's no free lunch.
Okay.
That to get a higher return, you need to take higher risk, and you need to take into consideration, as I say, the bang for your buck. How much return are you getting for a unit of risk that you are taking? But yes, you're absolutely right. The higher standard deviation number means you've got more extreme outcomes. So there's a higher probability of more extreme losses. But of course, by the same token, there's a higher probability of more extreme gains. But it does, in general, mean you've got a much wider spread of potential outcomes.
So that really, to me, underscores again, I'll say it again, underscores the importance of really understanding the numbers and being an advisor. Because if you're a consumer out there in the marketplace and you want to buy a house here in Singapore, and of course the government encourages everybody to own a house, yet we know that that's an asset class that's a bit more risky than, let's say, bonds. So that really underscores the importance that you get good advice, that this decision's not made based on hearsay, as Brent alluded to, that you really got to understand the numbers and protect your client as best as you can against one of those very risky or standard deviation results.
Absolutely. And another perspective on this is the notion of correlation. It's if you're invested in a particular asset, how much does that asset move with another asset? So the numbers here can range from minus 100% to plus 100%. So plus 100% would mean, let's say you had two assets, they would do exactly the same thing at the same time. If it was minus 100%, they would do exactly the opposite thing at the same time. So if one went up 5%, the other one would go down by 5%. If it's plus 100%, if one went up by 5%, they both go up by 5%. So what I've shown here is correlations for that same sort of return series we were looking at before for non-landed and landed property in Singapore against the variety of the same sort of different assets that I was looking at. And you can see the correlation for Singaporean property with Singaporean equities is quite high. So property and the equity market, I'm sure no one will be surprised by this at all, property and the equity market in Singapore tend to go in the same direction at the same time. Versus something like bonds, US bonds will tend to go in the opposite direction from Singapore. Bond returns tend to go in the opposite direction from Singaporean property. So one of the things that I always think about in terms of forming a portfolio is, of course, diversification. Now, if you're holding two assets that are doing the same thing at the same time, that's not diversification. You might think you're diversified because you're holding more than one asset, but in reality, if they're doing the same thing at the same time, you're basically making the same bet twice. So what you want to do is ideally what you want to do is have a portfolio of assets that are doing different things at different times. So, for example, if you've got an investor who is holding a lot of property, and they're thinking about diversifying, would they diversify into Singapore equities? Well, you might hold some, but you might also consider investing in things like bonds, I've got here US bonds, world bonds, and corporate US AAA rated corporate bonds, because they're doing something different to Singaporean property. So it's a case of diversification. So, again, I'm not making any recommendation here at all in terms of what someone should do, because it's totally down to that person's individual circumstances, what's most appropriate for them. But the key is you need to think about how property relates to a person's overall investment assets. And of course, again, then if you get into more granular property data, you might be able to find certain types of properties which are doing something different from, let's say someone's holding one particular type of property. You might be able to find a type of property which is doing something different at the same time. So you could hold more than one type of property and be diversified. But these are the sort of issues that I think are very important to think about in terms of understanding the kind of risk you are taking. Because as I say, if you're taking the same bet twice, you're not reducing your risk. You've essentially got the same level of risk. I like to think also, I mentioned macro, I like to think a lot in terms of the relationship between various assets and the macroeconomy. So I've got a chart here. The white line is Singaporean GDP growth. The red line is changes in non-landed property prices in Singapore. And the two of them, you can see, tend to go in the same direction. So probably no one's surprised by this. The economy in Singapore and property prices in Singapore are quite closely related. But therefore, if you know that, that's an important thing to take into consideration when making investment decisions. If you've got an investment decision, if you have a particular view on GDP, particular view on the Singaporean economy, history would tell you that implies a certain view for Singaporean property. Similarly, it's not just Singaporean economic activity which seems to matter. There's external, overseas economic activity has an impact, because of course Singapore economy is correlated with the international economy. So the white line here, the red line's the same, it's the same property price changes. The white line is US business confidence. That's called the ISM. It's actually manufacturers in the US, their business confidence. And you can see the peaks and troughs in those, and they're not perfect, but the peaks and troughs line up reasonably well. So, the US economy makes a difference for Singaporean property. And this is, in this case, again, the red line's the same property price changes. The white line is changes in US interest rates, 10-year interest rates. And you can see, again, these line up reasonably well. So there's a lot of macroeconomic data which actually influences the Singaporean property market. And that's something to take into consideration. I think it's very important to have an economic view when you're thinking about the Singaporean property market, because the economy very strongly influences, or is at least correlated with the property market. So I put together very quickly a very simple model, one for non-landed and one for landed property in Singapore, where I just put together a variety of macroeconomic indicators, so things like Singapore money supply, disposable income, GDP, a few other factors. And with those simple factors, 4 of them for non-landed property and 5 of them for landed property, I could explain 2/3 of the historic variation in Singaporean property prices, which is a pretty astonishing number. 2/3 of what has driven the property market in Singapore, changes in the property market over the course of since 1995, can be explained by what's going on in the Singapore economy in general and by some international effects. And I'm sure you could actually make these numbers higher than 64 and 67%. I'm sure you could ratchet that up. But it does highlight that there's a big component to what's going on in the a big macro component to what's going on in the Singaporean property market that you need to take into consideration. But then, of course, that also means there's a third or more which is driven by the micro, which is driven by what's specifically going on in particular projects, what's specifically going on in certain areas. And that's, of course, where in particular the SRX data becomes very valuable, because you can use that to help you understand and to help you explain the part that isn't explained by the economy. And that's where you need that much higher level of granularity of data. Oh, and I wasn't sure whether Sam was going to leave this in. Actually, just for a laugh, I was also interested in the idea of, the wider perspective. We're all sitting here in Singapore, and we think about Singaporean property in terms of Singaporean property. But of course, a big driver of Singaporean property over the course of the last several years has been international investors. International investors can look at any property. And I just found online this particular property was up for sale for, the sticker price was about 2 million Singapore dollars, about 1,800 square feet.